You're looking to buy a house in Canada. You know you need a mortgage, unless of course you've got hundreds of thousands of dollars in cash, just like me. Oh, if I had 20, this would have been funnier. So in this video, I want to teach you everything you need to know about mortgages in Canada. Hey there, and welcome to 𝗳𝗶𝗍 Real Estate. My name is 𝗳𝗶𝗍 from Real Estate agent in Regina, and that is my trusted assistant, 𝗳𝗲𝗿𝗁. I've been fortunate enough to help hundreds of people buy homes, many of them first-time home buyers. And most of them are saying, I don't know anything about mortgages. So I want to teach you, call this Mortgage 101. But if you're new here, there's something I always do in every one of these videos. I start them off with a terrible bad dad joke. How do you get a Kleenex to dance? You put a little boogie in it. If you have a better joke than that, I know you do, put it in the comments below. Let's teach you everything about mortgages in Canada. I want to start off with a really important message, and that is a mortgage, it's a product. It's not just an interest rate. So the lowest interest rate might not actually be the best mortgage. Often those ultra low interest rates come with very restrictive mortgages that might not be right for you. The interest rate is just the cost to borrow that money. Those ultra low interest rate mortgages, well, they might not have things like mortgage portability or the ability to prepay it sooner. And if you have to get out of the mortgage, the cost to break that mortgage could be tens of thousands of dollars. And you might be fine with that. Just make sure you know what you're getting into before you sign on the dotted line. So when talking about interest rates, you've got essentially two categories: fixed rate mortgages and variable rate mortgages. And just because the Bank of Canada just dropped rates doesn't mean you're going to get a lower interest rate. When it comes to fixed rate mortgages, historically, they have been more expensive than variable rate mortgages. You're going to pay for payment security. And what determines those interest rates is the bond market, not what the Bank of Canada is doing. So when the Bank of Canada changes rate, fixed rates stay the same. And when you have a fixed rate mortgage for the entire term of your mortgage, the interest rate doesn't change. A variable rate is entirely dependent on what happens with the Bank of Canada. So if the Bank of Canada drops interest rates, that rate will go down. But if they increase rates, your mortgage will get more expensive. You have to decide which of those options is best for you. If you're someone that wouldn't be able to sleep at night not knowing what your mortgage payment is going to be next week, fixed rate might be a better option. If you're somebody that doesn't mind that risk and is willing to take on the chance that you're going to get a lower interest rate, variable rate could be a better option for you. Now, I mentioned in fixed rates, it's for the term of your mortgage. In Canada, a term can be 1 year, 2 years, 3 years, 4 years, 5 years, 7, or even 10 years. Yes, you can get a 10-year mortgage in Canada. I'm going to not really talk about the 7 and 10-year mortgages because for the most part, those rates are so uncompetitive, really nobody even looks at them. The term is essentially how long you are with that bank. So if you sign up 5-year term, and predominantly people do, you have that interest rate, if it's a fixed rate, for 5 years. Then when you come up for renewal, you will renegotiate with the bank and potentially have a different interest rate. You've probably heard the term before: date the rate, marry the house. This is where that comes from. This probably seems a little bit overwhelming. So why don't we have a call and chat about it? If you're looking to buy a house in Regina, I'd love to be your agent. I truly enjoy working with first-time home buyers. And even if you're not looking to buy a house in Regina, I've still got you covered. I have a great network of agents from across the country that specialize in first-time home buyers, and I want to get you connected with them. So if you look in the description of this video, right below there, you're going to see a link to my calendar where you can book me in for a first-time home buyers consultation. And if you're in Regina, why don't we grab a coffee? The length of term matters because if you have to break that mortgage before that term is up, there's generally going to be a penalty. And usually with fixed rate mortgages, it's more expensive to break that mortgage than it is with variable rates. So make sure you know if there's a possibility you're gonna have to break the mortgage, what that payable penalty could be. Next is what's called the amortization. That is just how long it's gonna take for you to repay that loan in full. That's what you're contractually obligated to pay it back in. You can pay it back sooner. And that's where prepayment options come into play. If you have the ability to pay that mortgage down faster than you're contractually obligated to do so, and there's no penalty for doing so, you can save yourself substantial amounts of money, often far more than a slightly lower interest rate. If you're a first-time home buyer or you have more than 20% down, your bank may offer you a 30-year amortization. So that's going to be smaller monthly payments, but you will typically pay more in interest over those 30 years. Go on a mortgage calculator and just see how much of a difference that 5 years makes. You're gonna pay a lot more in interest generally over those 5 years. If you're not a first-time home buyer or you don't have 20% down, then the longest amortization you can have is 25 years. You may have heard in the news about all these negatively amortized mortgages or 70-year mortgages. I'll get into that maybe in a future video. That's called effective amortization. I'll tell you this right now, nobody is getting a 70 or 80-year mortgage in Canada, and no, they can't take 70 or 80 years to pay it back either. Now let's talk about down payments, because the minimum down payment changes by what the purchase price is. Maybe we'll get out the calculator here. I've got a couple of examples, so follow along. If your purchase price is under $500,000, then the minimum down payment is 5%. So as an example, if your purchase price is $300,000, your minimum down payment is $15,000. And I know if you're watching this video from somewhere like Vancouver, Toronto, a $300,000 purchase price sounds absolutely ludicrous. My market, that's basically the average house price. And we're talking like single family homes with a double detached garage, not a tiny little 400 square foot bachelor condo. If your purchase price is over $500,000, but under $1.5 million, then your down payment is going to be 5% on the first $500,000 and 10% on the balance. As an example, say your purchase price is $750,000. 5% down payment on the first $500,000, $25,000. On the next $250,000, $25,000 as well. So your total down payment would be $50,000. If your purchase price is over $1.5 million or it's an investment property, it's always gonna be 20% down. But there's a catch. There's always a catch, isn't there? If you have less than 20% down, that's what's called a high ratio buyer. I've seen people referring to those with less than 20% down in my comment section before as subprime borrowers. That couldn't be further from the truth. In fact, when you have less than 20% down, mortgage qualification is harder than if you had 20% down. The catch is that you have to have what's called mortgage default insurance. A lot of times this is referred to as CMHC fees. There's actually 3 companies in Canada that offer mortgage default insurance: Sagen, Canada Guarantee, and of course, CMHC. But this insurance, it's designed to actually protect your lender, the bank, but you have to pay for it. Yeah, the banks always win in this. If you have a 5% down payment, your mortgage default insurance is 4%. If you have 10% down, then it's 3.1. And if you have 15% down, it's 2.8. Once you get over that 20%, no CMHC fees. And this fee gets added onto your mortgage. So if you're only putting 5% down, you're basically adding another 4% on your mortgage, meaning day one, you essentially own 1% of your house. So like the sink in the tub, maybe? That's all the important details of a mortgage, but you're probably wondering, how do I qualify for a mortgage, or do I qualify for a mortgage? Yeah, come on, like get to the good stuff already. Today, Junior? What I'm gonna give you here is general guidelines, because anytime you're applying for a mortgage, it's always dependent on your specific situation. And there's all different types of variables. Do I need some sort of a legal disclaimer in the description? I don't know. This is not financial advice. I'm just trying to get you educated. First off, you're gonna need a decent credit score. Under 600, yeah, it's probably not gonna happen. Between 600 and 650, you'll get qualified, but you won't get the best rates generally. From 650 to about 720, that's when you're gonna get the best rates. Anything above 720, that's just for bragging rights. You're not gonna see a better rate.
And I love all people, rich or poor, but in those particular positions, I just don't want a poor person. Does that make sense?
Good credit is just the start. The next thing the bank's gonna look at is what's called your debt service ratios. Now, a misconception about qualifying for a mortgage is it's not your income versus the purchase price, it's income versus the amount you're borrowing. A larger down payment will allow you to qualify for a more expensive home. And there's 2 of these debt service ratios that are important. The first is called gross debt service ratio. So that is the mortgage payment, property taxes, and usually an average of what a heat bill would cost. All those combined cannot exceed 39%. And this is a percent of your income pre-tax. They always take out what your tax bill would be, so it's just 39% of what your total income is. Then you have what's called the total debt service ratio. So this includes any sort of car payments, lines of credit, any other revolving credit. If you have outstanding credit card balance, all of that gets added up together, and then that monthly payment with all that mortgage cannot exceed 44% of your income. And this is where debt really starts to matter. For every $100 you have in a payment, say a car payment, it knocks about $20,000 to $25,000 off your max purchase price. The bank is also going to look into your credit history. They want to know, have you been borrowing money and have you been able to pay it back? That's important to them.
Where's my money? You gonna give me my money? Where's my money, man?
But how does the bank know how much money you make and what you qualify for? They're going to want to see your tax returns. Simple as that. If you're on kind of an hourly wage or salary, they're going to see your last 2 years of income and those tax assessments. If you're in a contract position with guaranteed wages, they may qualify you on just that. You might not have to have the 2 year of income history. Okay, so that's great. Do I just go to the bank now? Well, yes, but you should rate shop, look around, talk with your bank, see what kind of options you have, make sure they fully pre-qualify you, meaning they pull your credit history, they verify your employment, your down payment, etc. And I'd also speak with a mortgage broker because they may have better options for you and potentially cheaper rates than your bank has. Remember, your bank, their job is to sell you a mortgage from that bank. Whereas a mortgage broker, their job is to get you the best rate possible because they want you as a long-term customer, and that could be with a different bank. As a first-time homebuyer, you've probably got questions about how do you buy a house in Canada? Don't worry, I got you covered. I got a first-time homebuyer playlist right here you can check out. Now, wait, hold up. Before you go and do that, give this video a like and subscribe to 𝗲𝗶𝗱𝗮 Real Estate. Thanks very much for watching.